in-house in corporate tax. I've worked in public oil and gas companies. I've been in accounting firms, and I own my own accounting firm based here in Reno. And so water rights tends to come up with many clients, especially with what to do with them, how to assess them. And so that's what some of the series is intended to address. So I'm excited to speak to you all today about the tax life cycle about water rights. Right. Tina, do you want me to go ahead and share my screen and I can start going through the presentation?
Yep, you are good to go.
All right.
Thank you.
All righty.
And thank you for letting me interrupt you with that record.
No problem.
Okay, thank you.
Okay, let me get this in present mode. So as I mentioned, today's topic is the life cycle of your water rights from a tax perspective. And this is something that a lot of people just don't realize that there are, the tax components and treatment of the water rights. And every stage, there's like either a decision made or inherently not made. And that's what we're going to address today. So I think the key that I'm going to mention is one, it depends on the state that you're in. That's going to dictate a lot of the treatment. And we're going to focus on, the cycle. So acquiring, holding, maybe leasing it out, transferring, selling, and how to account for that from a tax perspective. And so our takeaways, um, are right up here. This is super critical is that, water rights are a special piece like in the tax code. Oil and gas is my background, and they also have really unique treatment in the tax code. A lot of it depends on structuring and documentation. So it's important to understand how the water rights are acquired. It's going to dictate how it ends up on your balance sheet, which we've talked about balance sheet in our initial presentation, the first one last month. And why that is important is because, for example, you can amortize, and so you can take like a deduction, right, against your asset, or it's just going to sit in your balance sheet and then you don't get a deduction. So a common question I get from clients are like, can I write this off? How can I write this off? And the answer is typically it depends on how it was acquired. So did you pick it up as like a piece of a larger transaction? Was it part of land, right? And so you didn't sever the water rights from the land. And it's also going to depend on what state you're in. Some states are going to typically like separate those. And it depends also on the documentation. So just as you go through this, think about your own water rights in your business and if that documentation is one, correct, and two, if that assessment has been made. Okay, so why are water rights unique? I'm probably going to harp on this a lot. And so from a state perspective, and a lot of the time, the Western states are going to be pretty similar in how they treat the water rights, that they can be like a separate right, a separate asset from the land, from your ranch. And that's where the benefit can be. So when you acquire a water right, typically either going to be in like a larger transaction if you're buying a business, if you are, transferring something from um, a farmer, rancher, or if you are getting like a perpetual water right designation. So the way you acquire it will kind of dictate how it's treated. And our example is going to be if you like purchase a ranch of land and your water rights. It's either going to be, part of the land, and then with land, you don't depreciate land, right? It just sits there. It's a has a value to it that you don't get to depreciate, don't get to deduct it. So if you're thinking about, well, how can I monetize my assets, or what do I do with them? Can I generate revenue from them? If it's part of your land, and it's not a separate right, then it can sit there. It can increase the value of your overall business, and you can sell it later on, include that as part of like a purchase, but you might not be able to rent it out. So if you're looking at acquiring water rights, those are important questions to ask is, if I buy it, can I rent it out? How do I sell it, transfer it, dispose of it? Those are questions you kind of want to answer up front, because it will dictate kind of if you get amortization deduction, right? The amortization is a reduces your taxable income. Uh, the questions you ask now will kind of impact the whole life cycle of the water rights. And it's also very critical the state that you purchase the water right in. And the IRS has dictated, right, the treatment. It just depends on, if it's a separate from your land, or if it's a capitalizable asset. Those are the areas that you want to document. You want to get CPA or attorney who's knowledgeable in that. They want to reference, the characterization of it. So I'm probably going to try to minimize all the code sections that I'm sharing with you today. But this is kind of what's critical is that, you can um, do more with your water rights than you kind of initially might have when you just acquired them, right, as part of a transaction. Okay, we've also touched on the impairment rules that came into play. So when you have your water right, it's an asset. An asset's going to go on your balance sheet. If it is on your accounting side, you might need to impair it for tax. We don't follow that treatment. So say you have $1 million of water rights on your books, and under that, accounting rules that we talked about in our last meeting, say we had to impair it because the water basin was not producing as much water, or there was a change to how much water you're able to use, and you had to impair it. So maybe it was worth 1 million, and now it's worth $500,000. From a tax perspective, it would stay at $1 million. So if you were amortizing that million over 10 years, you still get to keep that amortization deduction. You wouldn't account for that impairment. So you have kind of two different sets of um, stories going on with your water rights. One is on the accounting side, and then one is for tax. So you can end up in a really great spot, right? If you're in the $1 million value and you're taking your amortization deduction over 10 years. So it's important to understand, the treatment. And this is just one of the impacts, right? If you want to take $100,000 of amortization deduction, that's, helpful for the business. Okay, so we're going to talk about leasing water rights, which is it's a potential, income producing asset from that perspective. Can come from right on your farm, business that acquired water rights, right? If it's sitting on a plot of land and you have a facility or some type of industrial um, energy, right? And you've acquired water rights and maybe you don't need all of it, um, you can look at leasing as a potential income generator. So the benefit with that is the category, the bucket that it would sit in. So you have passive income or active income. Passive income is similar to your like rental income. So you have like a rental property, you rent it out, and it's passive income. Active income is your like wages, like your W-2 wages is the most common example. So if you own water rights as a flow through business, like a partnership or an S corporation, or you as an individual hold water rights just as part of your overall, asset diversification. Um, this is where it's really important to know if it's passive or active. So active will be in the type of situation if that's just part of your business, like if you're trading water rights, that's pretty key. If it's passive, then it's going to offset other types of passive income. So investments is a common passive one. So if you're going to rent out your water rights and you're going to get leasing income. It's going to fall into two different buckets, passive or active. If you're on an individual side, if you like are a corporation, the passive or active doesn't quite matter. But for an individual, it can make a big difference. A lot of people invest specifically, into short-term rentals so they can get active type of business income. So this is going to fall into that review if it's passive or active. If Again, if you're like ordinary trading water rights, you're going to sit in that active bucket. If not, it's going to be passive. If you are active in like the water right leasing business, you're also going to owe self-employment tax, and that's a really common surprise. So self-employment tax is common if you own an LLC and you have to pick up that income on your personal return. Self-employment tax will be attached to that type of income. Same thing if you are in this active bucket. So when you're modeling out, for the year, I'm going to generate, $100,000 of rental income from my water rights. Just make sure you withhold enough, on your side to pay the taxes for that income. So we've talked about acquiring and what is important about acquiring your water rights. We've talked about, the passive and active treatment for the leasing, when that's income, right? When that's coming through as income for yourself. We've talked about our next topic. Okay. So this is where there's real opportunity in the value. So we can talk about it in the lens of uh, like real property. So if you have a rental business, right, you're renting out um, to individuals, you have rental property. The big benefit of real property, which water rights, depending on how it's acquired and how you've identified where it's going to sit on your balance sheet, can be treated as real property. So real property has a broad category, right? Land, a building, rental property, water rights could sit under that category. If you are looking at your assets, you want to monetize them, maybe sell them, if you have water rights that are treated as real property, and please talk with your CPA before you do this, and say the value was, $1 million, but you bought it for $100,000. That's potentially $900,000 of gain. That'd be a big tax bill, right? If you were to sell those water rights. You have an option for doing a 1031 exchange. And again, that's really common in the like real estate world, and real estate investors definitely know what the 1031 exchange is. But basically, it allows you to defer paying tax on that gain, kicks that can down the road. So if you have $900,000 of gain, that take 21% of tax on that, that's real value that you are saving from the cash side, right? You will owe it at some point, just you're kicking the can down the road. And that is something called a 1031 exchange. It's limited to real property. Um, Oil and gas wells also qualify. Land, undeveloped land, real estate can all fit in that category. So that's where it's a really great opportunity. Like say you have, historic water rights in your family, as an asset, or if it's in your business and maybe you are scaling into a different category of your business and you don't need the water rights. I mean, it's just an opportunity. And then from a capital gain perspective, it's typically going to be long-term capital gain if you've held the water rights for more than 1 year. So that's kind of similar to if you hold just like a stock, right? If you own Google, you've held it for a year and then you sell it, that's going to be long-term capital gain. So make sure you've held it for at least a year so you get that treatment. The worst thing you could do is sell it after you've held it for less than a year. And then you're going to be on like your regular ordinary tax rates. So just be mindful of kind of what you do with your water rights, how they're documented, how you kind of assign the characteristics to it, because again, there's real value, especially when you are looking at transferring or selling those water rights. Um, there's also something called installment sales. And so you can basically recognize gain over multiple years versus recognizing it all like in year one. So that's just a good way to kind of manage cash flow from like a tax perspective. And then, of course, you're going to want to check your state rules, like check what state you're in, because some states will, that they typically will follow the capital gains treatment. But it depends on, what state you're in. It could possibly say, it's a amortizable asset. It's not an amortizable asset. So you just want to kind of bucket that in the right way and structure it so you can get the best value out of your water rights. Okay, so here, this is probably the most valuable part is going to be identifying common pitfalls. And this is something I've encountered is misclassification, where maybe you've, bought the water right and we thought it was a separate asset, right? And we're doing all this amortization and deduction and you're, reducing the value over time. And then we go back at the initial documentation, right? When we go to sell and we say, oh, it was actually, it was part of the land, it was not severed. You shouldn't have been taking amortization. And so that value that's sitting on your balance sheet is still that $1 million. So if you sell at $1 million, it will have a big impact on, the gain that you will recognize down the road if you were to sell it. You also want to make sure you have the documentation for so we talked about the gain, the 1031, because if it is real property, you have that 1031 optionality. If not, then maybe you can take the amortization deduction. So you want to make sure that you're getting the best tax treatment, right? You're going to be most tax efficient with your water rights. And it's really down to kind of what is the documentation when you acquire it, or how it's inherited if it is like a family asset. Okay, so second pitfall is actually just never assigning a value to it. We talked about value and kind of how to determine that in our last meeting. There was like three different options, and some of we can, discuss those, or I can share those with you, the kind of the three different ways to value it. But a big pitfall is just, you got it, acquired it, and it's just sitting, as bundled into your assets on your balance sheet. And maybe it was, a perpetual water right that was acquired with priority, 50 years ago. That's a pretty high value. Um, and that could be great for your assets as a business, great from like asset diversification if you are an individual investor. So yeah, it's just great to get the value. Just document it and identify early on, because if you're trying to do a deal later, these types of things will hold up the deal. Okay, where's number three? Um, so the third one was a pitfall related to leasing your water rights for rental income. So rental income is inherently passive income. If you have a ton of passive income, do you want more passive income? Do you need it? Is it worth it? Right? That's just something maybe model initially, before you go down that path. If you have a bunch of passive losses, right? If you have other business activities, right? You have your rental real estate, maybe you need passive income to offset your passive loss, right? You can kind of offset like one category of loss with a different set of income, and you can make use of those losses. That's a great opportunity. But what you don't want to have is water rights that is active and then you're trying to offset a passive loss. So again, those are very like tax terminology. But review your tax return, especially for an individual, and you're considering, what you can do with your water rights, how to monetize them from like a leasing perspective, and talk to a CPA or just talk to someone knowledgeable before you go down that route. And then pitfall 4, and this is really big on the 1031 transaction in general. The biggest issue with 1031s, people miss this 45-day window. So if you want to use the 1031 feature, you can sell your asset. And if you want to trade it, right, you're going to swap it for a similar like kind asset, which is another like real property. You have 45 days to identify, and that 45 days will go fast because it's 45 um, actual days, not business days. So that's what I've experienced in the oil and gas role like hiding exchanges is incredibly powerful, right? When you get to defer gain down the road, but that 45 days will come quickly. All right. So I'm going to run down my list of key takeaways. One is having a checklist. So in our previous meeting, we also I gave out a list, just like a way to account for and document, all the water rights that you have, like all the attributes. Message me and I can send that to you again. So the checklist is going to start with one, what state are you in? What's the treatment? What's the characterization? Is it real property? Is it an intangible? If it's real property, then you don't get to take depreciation adjustments. If it's an intangible asset, you get the amortization deduction. And so there's going to be benefits and features, right? Through the life cycle, you either get amortization deductions or you don't, and it just sits at your value. And then you will recognize that, on the back end when you sell. To decide how you want the water rights to be accounted for when you are acquiring it. So this is in general when you're doing a transaction, you're going to want input into the allocation. So say you're buying land with water rights. For whatever it is that your business is doing. And so maybe the land plus the water rights combined is $2 million. You can't depreciate or amortize land. So it's just going to sit there. It's not helpful. You're going to want to push um, value. You're going to allocate the purchase price more to the water rights if you can. And if you can get it to be accounted for as like a intangible asset, because then you can get amortization deduction. So it's just going to help you in the long run, right? If you get deductions throughout the year, reduces your taxable income. So that's a key feature when you're negotiating the acquisition or the purchase price allocation on those water rights. Documentation, please document. Your attorney, your accountant will all be happy with the more documentation that you have versus, oh, we guessed that, when we inherited this water right, it's going to be treated as X. And it's very hard to plan or prepare a tax return off of someone's guess. So documentation is key. Make sure you identify if a 1031 exchange is available. That's next on my checklist. And last, just please consult with like a knowledgeable person in this area, like an attorney or just someone who has background in this because there's real dollars at stake. We are coming close to time. I wanted to leave room for some questions. And I know I ran through a lot of information. I really harped on the acquisition of the water rights, the state you're located in, how it's going to be treated from, is it an intangible asset? If it's intangible, you get amortization. If it's a real property, then it might just sit there, right, as it's at its value, but you could lease the water rights for rental income. So there's all these opportunities to monetize and be tax efficient with your water rights from acquisition all the way through, selling, disposing, or transferring it. So we are at 40 minutes. I am going to open it up to questions. See, I need to exit out
Michelle,
of
can
here.
you see that Jeff has his hand raised?
Oh, let me open. Oh, okay.
There we go.
Hi,
Awesome.
Michelle. Michelle, can you hear me?
Yes, I can.
Great, thank you. Great presentation, thank you. And So I'm Jeff Fontaine. I work with two rural regional water authorities, and one of the programs that we implemented a few years ago is a water rights retirement program. And so we kind of went through some of this with some of the water right holders who wanted to voluntarily retire their water rights to the state and then use the 1031 exchanges. My question is, and I know you kind of addressed this maybe in an earlier presentation that I didn't see, but how do you determine the basis? Does it require a formal appraisal? And if so, I mean, that's there aren't a lot of standalone water rights appraisers or appraisals that I'm aware of, or at least a lot. So I guess I'm just curious about how you determine what the basis is for the individual water right.
Sure. And I can send you the presentation from last month. And you
Okay,
definitely,
that'd be helpful.
I
Thank you.
definitely can. Yeah, there's like three different ways to allocate value. One is speaking with an appraiser and maybe not limited to like a water rights appraiser. And I know several people who do like their valuation um, specialists. So they would kind of be the first go-to. And you're going to look at the document, and the document most likely is not assigning right to all of the different categories of acquisition. From my experience, when you purchase something, there's either going to be an appendix, and there really has to be a lot of negotiation to identify all of the components of what was purchased. Is usually an Excel schedule, like on the back end, right? If it's like more sophisticated business, if it's an individual, um, it's more, I think, open-ended. And I think coming up with a fair value based on one of those three approaches that I had um, talked in the last presentation, that is the most reasonable way to go about it because I think if your initial basis you don't, it's a big question mark. Two is to just estimate the value at that time and then go back and see what was in your documentation. And that's where that appraiser will come into play. So because I think most people in the water rights world know that the value can be much, much higher than the basis that it was acquired from. So the gain is going to be at play. Um, so yeah, I would go back to the initial documentation. It could be murky, right? If it's like an individual and maybe not sophisticated to kind of allocate a dollar amount to it. But then talking to like kind of any evaluation specialist will get you in a better spot than if you're just guessing.
Yeah, without having seen your earlier presentation, I'm kind of thinking this through. And, a lot of water rights, at least in Nevada, have been either inherited or when they were first acquired, either, through a permit and then later put to beneficial use and certificated, the values are just, and it just depends. So I guess you can maybe determine what the water right value is if you were doing, for example, an arm's length transaction for retiring, for leasing them or selling them. But to go back and try to estimate what the original basis was at that time when you acquired those water rights just sounds really complicated to me. But
I think the best answer is just getting it out of zero because whatever value minus zero is going to get you into the worst answer, so to
yeah,
speak.
yeah.
Yeah, I think if there, I don't know if there's, county records for how, the transactions, and I know the older years you go back, there's probably very few records. But sometimes I've seen people go back to just like county documents, right? Like in the oil and gas world, from my experience, right, if there's leases or water rights handed down through the family, sometimes you can go to like county records and go and find that initial transaction. But yeah, valuing it, I think you kind of have to like work your way backwards and get to like a reasonable answer, but just don't use zero. That's really what I just,
Can I
just
ask a
don't use
quick
zero.
follow-up, if
Yes.
that's okay? Um, would the cost of putting the water to beneficial use to work? So if you have to, when you get a water right, if it's a groundwater right, you drill a well and put in an irrigation system, those kinds of things in order to perfect that water right. Is that cost um, calculated as part of the basis? I mean, can that be used to reduce your basis cost?
Usually use to cap it, you usually will have to capitalize that cost to your water right because that's like a way to make it usable, make it better.
Right.
Yeah, yes, you can
Okay.
capitalize that. So that's like good basis, so to speak.
Okay. Thank you.
You're welcome. I think we got a message question from Steven. What is the likely tax treatment for water rights purchase with a groundwater management plan, where the right will suffer a two-thirds haircut reduction over the next 15 years? That one we'll have to double check one, how it was acquired, but the potential haircut that might be on the like that accounting piece where they might have to calculate an impairment. And then from a tax side, the impairment is not, we just ignore it from a tax side. Um, if it's if you acquire it and it's a intangible, you would just take your amortization deduction and just take it over the years, and then you have your basis difference between what's sitting on your like financials and then what's sitting from a tax perspective. So hopefully I answered your question, Stephen. You can always email me if you kind of have more background to it, and I can help answer it as well.
Okay, does anybody else have any questions? No? All right. If you think of any questions after we end this webinar, then you are welcome to email them to me and I will forward them to Michelle. And we do thank you for your time. We thank our sponsors for our webinar series for the 2026 year. And you will receive a thank you follow-up email from Lauren with a certificate of attendance and the evaluation survey to complete. So thank you for joining us today. Michelle, thank you. Thank you for sharing your time and your experience with us. And if there's anything you think of that we need to know when this ends, then you're welcome to send that to me as well, and I will forward it to everybody. And if not, then I guess we'll see you in August.
That sounds wonderful. Thank you so much for your time today, and I look forward to seeing you in a month.
All righty. Have a great summer or great July. See you in August.
You as well.
Thank you.